Tomorrow is one of the most important days in the gold and silver market this year, and I am not exaggerating when I say that. Tomorrow, February 24, 2026, China reopens. The Shanghai Gold Exchange, the Shanghai Futures Exchange, the Shenzhen Stock Exchange, all of them have been completely shut since February 15th. 9 straight days of no Chinese trading, no Chinese buying, no Chinese price discovery in precious metals. And here is the thing that most people are not fully grasping right now. China is not just another country that participates in the gold and silver market. China is the largest physical buyer of gold on the planet. China controls between 60 and 70% of the world's refined silver supply, and China's domestic industrial demand for silver is so intense that the Shanghai silver market has been in a state called backwardation, which I will explain in detail, for months. When the world's largest metals buyer goes offline for 9 days, the market notices, and when it comes back online, the market reacts. The question I want to answer for you today is this: what happens next? What does China's re-entry actually mean for gold and for silver? In which direction does the market move from here? To answer that properly, we need to understand exactly what China has been doing in these markets before it went offline, what happened to prices while China was absent, and what the data is telling us about what comes next. Let us start with gold, because the numbers from January are genuinely remarkable. The World Gold Council just released their China gold market update for January 2026, and the data inside it is extraordinary. The LBMA gold price in US dollars recorded its highest January since 1980. Let that land for a moment. The strongest January for gold in 45 years. Meanwhile, on the Shanghai benchmark, the RMB gold price saw the strongest start to any year since the Shanghai Gold Exchange was established. Both of those records happened at the same time in the same month. And what was China doing during all of this? Buying, consistently, aggressively, and at every level of the market. Chinese gold ETFs added the equivalent of $6.2 billion in January alone, 38 tons of gold in 1 month, just through ETFs. That was the strongest start to any year on record for Chinese gold ETFs. Their total assets under management reached an all-time high, their total holdings reached an all-time high. And wholesale demand was equally robust. Banks, jewelry manufacturers, and refiners withdrew 126 tons of gold from the Shanghai Gold Exchange in January. That is 11 tons higher than December. The reason for that increase was twofold. First, gold bullion sales were strong because the price rally attracted investor attention. Second, jewelers were restocking ahead of the Spring Festival holiday, wanting to have inventory ready for the gifting season, which is one of the biggest gold buying periods in Chinese culture every single year. And on top of all of that, the People's Bank of China announced its 15th consecutive monthly gold purchase, 15 months in a row without stopping. In January alone, they added 1.2 tons to their official reserves, bringing China's total official gold holdings to 2,308 tons. That now represents 9.6% of China's total reserve assets, and every single month for 15 consecutive months, they have bought more. Now let me explain why that number matters so much. Central banks do not make impulse decisions. They think in years and decades. They move slowly and deliberately. When a central bank buys gold 15 months in a row without stopping, they are not making a trade. They are making a policy statement about the future of the global monetary system. They are saying in writing, through their balance sheets, that they want more gold and fewer US dollars. Now let's talk about what happened during the 9 days China was closed, because this is where it gets very interesting. When China went offline on February 15th, there was a very specific and predictable dynamic that took hold in global markets. Prices softened. Gold dropped as low as $4,898 per ounce on February 17th when the holiday began. Silver dropped to $74.46 on the same day. This is actually a well-documented pattern. When China, the world's largest physical buyer, goes offline, 2 things happen simultaneously. Physical demand falls sharply because the biggest buyer is not buying, and liquidity in the market thins out because Asian trading desks go quiet. In that thin, low liquidity environment, prices become easier to push around in either direction, and they often drift lower due to profit-taking by traders who got in before the holiday. But here is the other part of that pattern that matters just as much. When China comes back, the price tends to recover. And this year, the recovery has already been happening. Gold bounced back to $5,120 by February 21. Silver recovered to $85.32. The market was already anticipating China's return before the gates even opened. Now, I want to spend some time on silver specifically, because the silver story in China right now is unlike anything that has happened in this market in recent history, and understanding it will tell you more about where prices are going than almost any other single data point. The Shanghai silver market has been in a state called backwardation. If you are not familiar with that term, let me explain it very simply. In a normal futures market, prices for delivery further in the future are higher than prices for immediate delivery. That makes intuitive sense. You would expect to pay slightly more for something delivered in 6 months than for something delivered today, because of storage costs, carrying costs, and interest.
That is called a normal or contango market. Backwardation is the opposite. It means that prices for immediate delivery are higher than prices for future delivery. And when backwardation happens in a physical commodity market, it is the market's way of screaming one thing: we need this metal right now, not in 6 months, right now. Shanghai silver has been in backwardation. The front-month silver futures contracts on the Shanghai Futures Exchange have been trading at a premium to later months. That means industrial buyers in China are so desperate for immediate physical silver that they are willing to pay more for metal they can receive today than for metal they could receive in the future. That is not a sign of a healthy, balanced market. That is a sign of acute physical scarcity. And the numbers confirm it. By December 2025, Shanghai silver inventories had fallen to just 531,000 kilograms at their lowest point. That is a fraction of what they were just a few years ago. The Shanghai Futures Exchange has seen short sellers, people who bet silver prices would fall, actually paying fees to long holders just to avoid having to make physical deliveries, because the metal is not there to deliver. German refining group Harius, one of the most respected precious metals firms in the world, specifically noted in their latest market commentary that the silver market in Shanghai is still showing tightness, with futures in backwardation. That comment was published last week while China was closed. The tightness didn't go away during the holiday. It was just sitting there, building pressure, waiting for the market to reopen. And on top of the existing shortage, China put a new policy into effect on January 1, 2026 that has fundamentally changed global silver supply. New export controls on refined silver. Under the new rules, only large, state-approved companies with annual production capacity of at least 80 tons can obtain the licenses required to export silver. This effectively shuts out hundreds of smaller and mid-sized exporters who have historically been major suppliers to the global market. China controls 60 to 70% of global refined silver supply. When you restrict that much of the world's supply to only state-approved exporters, you create an immediate and structural shortage in global markets. This is not speculation. This is already showing up in physical premium data around the world. In Japan, physical silver premiums on secondary markets have been as high as 60% above the global price. In the UAE and Dubai, premiums are around 40%. And in Shanghai itself, physical silver was trading at an $8 per ounce premium above COMEX futures prices for most of December and into January. An $8 premium on a commodity that was trading around $75 means physical buyers were paying more than 10% above the paper price just to get their hands on real metal.
Now, here is the question you should be asking. If physical silver is already this tight in China, if the market is already in backwardation, if global premiums are already this elevated, what happens when the largest industrial user of silver in the world comes back online tomorrow after 9 days of no buying? The answer, based on everything the data is telling us, is more demand hitting an already stressed physical market. But there is another layer to this story that I want to make sure you understand, because it is not just about China buying. It is also about what China stopped doing. For years, China was both a consumer and a supplier of silver to global markets. Chinese refiners processed silver ore and exported refined silver to Western markets, helping to plug the growing supply deficit that has existed for 6 consecutive years. That flow of Chinese refined silver was one of the reasons Western markets like London and New York could maintain relatively balanced supply and demand, despite the structural deficit. Now, China has turned off that tap. They are keeping their refined silver at home, prioritizing their own solar panel manufacturers, their own semiconductor industry, their own electric vehicle supply chains. And those industries are growing, not shrinking. China's solar panel production capacity is the largest in the world and is still expanding. Their EV production hit record levels in 2025. The industrial demand for silver inside China is not going to slow down. So you have a situation where China was previously both a major buyer and a partial supplier of silver to the world, and now they are a major buyer only. The supply contribution is gone, the demand remains, and the rest of the world has to find its silver somewhere else, in a market that already has a 230 million ounce annual deficit. This is what the analysts at FX Street called a perfect storm of policy, supply, and industrial demand, and it is not hyperbole. Now, let us look at what the data says about where gold and silver actually go from here. For gold, the picture is clear, and the direction is up. Every major bank with a credible forecast is pointing in the same direction. Goldman Sachs has a price target of $5,400 per ounce by year-end. Bank of America has put $6,000 on the table. JP Morgan is forecasting an average of $5,055 in the fourth quarter of 2026. The Federal Reserve is expected to cut interest rates at least twice this year, with the first cut priced in for June. When that happens, the cost of holding gold falls to zero, and capital floods back in. The structural case is even more powerful. State Street's monthly gold monitor, published just days ago, noted that gold remains under-owned as an asset relative to the size of global equity and bond markets. That is remarkable when you consider it is already at $5,000. There is still a massive pool of institutional capital that has not fully repositioned into gold. When they do, it adds another wave of buying on top of the central bank bid that is already relentless. And this week, China's re-entry adds fresh physical demand to a market that was already tight. The gold price premium in Shanghai went from a discount of 1% last September to a premium of 1% in February, the highest since last April.
That shift from discount to premium tells you the same thing the silver backwardation is telling you. Physical demand in China has reaccelerated, and supply cannot keep up. For silver, the direction the data points is also higher, but the story is more complex, and the potential move is larger. Silver is currently at approximately $85 per ounce. It hit a high of $120 on January 29 before the historic sell-off that took it all the way down to $64 on January 30. In less than 3 weeks, it recovered back above $85. That is a 22% recovery in 3 weeks from the low, and it happened during a period when China was either preparing to close or already closed. When China comes back tomorrow, the additional physical demand hits a market that is structurally undersupplied, physically scarce in Shanghai, running a 230 million ounce annual global deficit, and dealing with Chinese export controls that have permanently removed a major source of global supply. The gold to silver ratio right now is approximately 62-1. That means it takes 62 ounces of silver to buy 1 ounce of gold. The historical average of that ratio is 45-1. With gold at $5,100, if the ratio simply reverted to its historical average, silver would be trading at $113 per ounce. Not some speculative fantasy number, a number derived purely from where gold is today and what the historical relationship between the two metals has been. Citi has a price target of $110 per ounce for silver by the second half of 2026. BNP Paribas is at $100 per ounce by year-end. Goldman Sachs is projecting an average of $85 to $100. Even the most conservative institutional forecasts are pointing significantly above where silver is right now, and the speculative positioning data is one of the most important signals of all. According to CFTC data, managed money net bullish positions in silver were sitting at $1.8 billion as of February 10. That sounds like a lot until you compare it to where it was just weeks ago. At the peak in December 2025, managed money net longs in silver hit $8.3 billion. The current level is 78% below the 5-year average. That means speculators have largely exited silver. The market is not crowded on the long side. There is enormous room for positioning to rebuild as prices recover. When speculative positioning is this low, while the physical market is this tight, it creates a very specific setup. The shorts are exposed to the physical reality. Industrial buyers are going directly to mines and paying 30% premiums to get their hands on real silver. And when China reopens tomorrow and begins restocking for its solar, EV, and semiconductor factories, the physical pressure on the market does not decrease, it increases. So here is what I think you should watch for in the days immediately after China reopens on February 24. Watch the Shanghai premium. If physical silver in Shanghai immediately trades back to a significant premium over COMEX futures, that tells you the demand shock from China's return is real and immediate. Watch gold ETF flows out of China. In January, Chinese gold ETFs had the strongest inflows on record. The early days of February saw brief outflows as the price dipped and the holiday approached. When the market reopens, if those outflows reverse back to inflows, it confirms that Chinese investors bought the dip and are back. Watch the gold price above $5,100. That is the technical level the market has been testing. If China's return provides enough buying pressure to push gold through and hold above that level, the next technical target is $5,300, which is the level Goldman Sachs identified as a key milestone in their forecast. And for silver, watch whether the recovery from $85 continues or stalls. The physical tightness is real. The backwardation was real. The export controls are permanent policy, not a temporary measure. If China's return adds demand to an already stressed physical market, the path toward $100 becomes much shorter than most people expect. Let me be direct with you about the overall picture, because that is what this channel is here to do. China's re-entry tomorrow is not a minor event. It is the return of the world's largest physical buyer of gold and the world's most intensive industrial consumer of silver to a market that has been running without them for 9 days. In those 9 days, gold recovered from $4,898 to over $5,100. Silver recovered from its holiday lows back to $85. Both recoveries happened without China. When China adds its demand back into the equation, the pressure that was already building in the physical market does not decrease. The structural deficit in silver does not go away. The PBOC's 15-month streak of gold purchases does not stop. The Chinese gold ETF investors who have been reaching all-time high holdings do not suddenly sell. They come back into a market that, by every data point available, remains structurally bullish. This is not financial advice. I am not telling you what to do with your money. That is your decision to make based on your own research and your own risk tolerance. But I will tell you what the data says. The data says China has been the biggest buyer of gold on the planet for 15 consecutive months. The data says Shanghai silver is in backwardation because there is not enough physical metal to meet immediate demand. The data says China's export controls have permanently removed a major source of global silver supply. And the data says that speculative positioning in silver is sitting 78% below its 5-year average, which means the market is far from crowded. China went offline 9 days ago. Tomorrow it comes back. And the market will feel it. If you found this breakdown useful and educational, please subscribe and hit the notification bell. This channel puts real data in front of you so you can understand what is happening, not just what the headlines say. Drop a comment below and tell me where you think silver will be by the time we get to our. I read every single one and I will pin the best responses at the top. Share this video with one person who is watching the gold and silver market but does not know China reopens tomorrow. That single fact changes the context for everything happening this week. This is the kind of information that matters, and I will keep bringing it to you. Stay sharp, stay educated, and I will see you in the next one.